I think that's just a function of the US still being one of the deepest liquid, really financial capitals of the world. But the trend is going in the other direction. And as that continues, and the BRICS and so forth start developing not only different ways to trade outside the dollar, but also diversifying their foreign reserves from US dollars into gold and euros and other currencies, we're going to see that slowly come down. And I think that's going to continue to drive more pressure on gold in the upside over the following year or two.
Brett Heath, CEO of Manala Royalty, discusses the major drivers of the gold price and takes a deep dive into royalty business. Heath predicts higher gold prices as countries reduce reliance on the US dollar and invest more in alternative assets, driving up gold demand. Foreign reserve holdings in US dollars declined from over 70% to about 60% in the past decade. The BRICS bloc is accumulating gold at a massive pace with a motive to take on the US dollar. The World Gold Council published a report highlighting that China purchased 102 tons of gold in 2023. On the other hand, Russia purchased 31.1 tons of the precious metal, while India accumulated 2.8 tons to its gold reserves. Though the developments look small at the global level, they could be a tipping point for the US dollar. Based on his observation, Heath predicts a potential breakout on the horizon following historical patterns. In terms of market fundamentals and risks, the current period is quite similar to the last quarter of 2008. Between late October and the last quarter of 2008, gold rose 22%, silver jumped 34.5%, and the GDX mining stock ETF more than doubled. In 2009, when breaking above its 2008 all-time high, there was again a consolidation of multiple weeks right below the resistance level. Brett Heath believes that the current situation with gold is also exhibiting a similar pattern. The dollar index fell 0.4% against its rivals after the Fed statement, making gold less expensive for other currency holders. U.S. 10-year Treasury yield slipped to 3.862%. Heath says diversification by central banks plays a bigger role in driving gold's price than the U.S. dollar's relationship. To be clear, the U.S. dollar remains dominant in global forex reserves even though its share in central banks' foreign exchange reserves has dropped from more than 70% in 1999, IMF data shows. The formation of a new BRICS currency was expected to hit a nail in the U.S. dollar's coffin. However, BRICS Ambassador Anil Sukal confirmed that the next summit in August will not discuss the creation of a new currency. This puts the U.S. dollar in safe territory as no other currency could challenge its global reserve status. However, BRICS using gold to topple the U.S. dollar's prospects remains looming at large. Ultimately, Heath believes countries diversify foreign reserves away from the dollar due to U.S. economic sanctions, as seen in the removal of Russian banks from SWIFT. We will now bring you clips of Brett Heath from his recent interview with David Lin. Before we proceed further in this video, please make sure to subscribe our channel and click the bell icon to stay updated.
What we've seen historically is that typically, after three tests, the fourth one comes through. We saw that actually back, very similar price action with gold in the 2008 to 2009 timeframe, right before gold, when it finally did break out. We saw it run from $1,000 to $2,000 an ounce. So right now, the gold's hanging in there. It's consolidated, I think, in a very healthy way. And right now it's really just in holding pattern. US dollar is very, very correlated with gold, and we see that with the price action kind of day to day. But again, I think it's more broadly based in regards to these longer term trends and the diversification out of the US dollar by a lot of the other central banks. And the central bank digital currencies will also probably play a role at some point, but I think it's too early to specifically see kind of what impact that would have. What we've seen is again, these are big long-term trends. And, I would say one of the major trends that we're watching was really the SWIFT system being weaponized. And when the SWIFT system was weaponized by the United States, primarily on Russia, that created all the other central banks around the world to start to slowly diversify their foreign reserve holdings. And we've seen foreign reserve holdings of US dollars go from a little over 70% over the last 10 years down to about 60%. So we've seen a significant decline. The US is still only about 24-25% of global GDP. So there is still a significant amount of reserves, bank reserves, significantly higher than the GDP. And I think that's just a function of the US still being one of the deepest liquid, really financial capitals of the world.
Heath believes that despite the gold price remaining high, there is an uncertain situation within the investment community. Royalty companies have the potential to impact the supply of gold in the market. When a royalty company sells its gold on the market, it can lead to an increase in the overall supply of gold, potentially exerting downward pressure on prices. Looking ahead, gold prices are set to close the month about 1.8% higher, marking the most significant gain since March. This surge is driven by the mounting expectations that U.S. interest rates may be approaching their peak, causing the dollar to head for its second consecutive monthly decline. According to Heath, as gold prices rise, smaller cap gold companies could experience significant share price appreciation and attract more investment capital, crucial for their success and growth. Let's get back to interview.
Well, a higher gold price for royalty companies means higher margin. So, again, royalties are free carried interest, and so there's no cost exposure from a royalty company perspective. When the gold price goes up, a lot of times the gold price goes up at the same time costs go up, or costs can sometimes follow in relatively short order. But what's the beauty about the royalties is that when the gold price goes up, that's 100% margin. Every dollar or $100 that the price goes up, it translates right to the bottom line for royalty companies. It's very interesting and a bit really a bit uncertain within the investment community, the way that gold has kind of reacted in a different way, given the central banks, given all of the geopolitical events. There's been a lot of capital flows that have gone into the physical metal. We haven't quite seen that yet within the gold equity sector. Broadly speaking, the very, very largest gold mining companies, the largest gold royalty companies have seen some capital inflows, but for the most part, what the market seems to be paying for is very, very significant size, very, very significant liquidity, and what that's really translated into is an incredible opportunity here, I believe, for smaller cap gold companies that have really good quality assets, because we've seen the gold price hang in there. We've seen the capital flows. We've seen the price very high, but yet it hasn't matched up to previous cycles that we've seen within the gold equities. And so there are today some really incredible kind of disconnects within the really high quality, call it sub 1 billion market cap companies that are within the gold sector. I mean, I believe that the M&A activity within the gold sector primarily has been driven on the lack of growth. I mean, that's what we've seen over the last couple of years, is that there has been less discoveries made in general. There are less projects that could be put into production that really meet the underlying hurdles of these big companies. And I think it's also been driven from a function of the market perspective, because over the last 10 years, we've seen basically every single sector expand quite significantly. At the same time, gold equities really hasn't expanded too much. And so in order to continue to be relevant, we've needed to see, not just on the mining side of the business, but also the royalty side of the business, there's been a push to consolidate, utilize all of the savings from the G&A costs, raise margins, but also be bigger and more liquid and more marketable to the larger institutions.
Ongoing shift boosts gold prices as countries adopt gold and other currencies. BRICS gold accumulation and potential new currencies signal global reserve landscape changes. What are your thoughts on the role of gold in the changing global financial landscape and its potential impact on the US dollar's dominance as a global reserve currency? Share your thoughts in comments section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.